All right, welcome back, everybody. Today we're going to be looking at getting into a cash secure put into the UVIX. It's UVIX, and I'm here with Danny. Hello, Danny. How you doing today?
Hey, Mark, how are you? Good to be
Doing
on.
great. Doing great, man. Excited to be looking at this trade today. This cash secure put that we're going to be getting into. Appreciate you getting on short notice. I've been, watching the market here the last few days and looking at. The way things are changing, moving, got some good signals in terms of market direction. But what we're going to look at today, Danny, is the UVIX. It's UVIX.
hmm
And what it is it's a 2X, what they call it is a 2X long VIX futures ETF. And the VIX, VIX, if you're not familiar with that, general, is a volatility. So the volatility measures the volatility of the market in general. It's based primarily on the S&P 500 um, on the short-term futures index. So there's a VX futures, and people actually trade in the futures market on volatility. But what we're going to do today is there's actually an ETF. Go ahead and go there, and that VTF, I'm sorry, ETF. Called the UVIX, which is this here, UVIX. It's currently trading at about $23.78. And what it's doing is following the moves on the VIX, which is the VIX. And if you notice in your indices and some of the, applications, just in, it may be one of the templates like with the Dow Jones, the SPX, which is S&P 500. Volatility is sometimes just part of that. So you'll see VIX, and it's a good measure of volatility. So whenever, like you see here, let's say, Danny, where, you get these spikes, generally when there's a lot of fear in the market or you call it volatility in the market, sometimes there's some bad news. There's things that are concerning to investors. People start selling. There's abrupt changes in volumes. The VIX will move in an upward direction. And conversely, when the market's calm and there's not a lot of fear and a lot of buying and just a lot of consistent momentum, then you'll see the volatility decrease. So you can see, we've been on a downward trend since let's say April, kind of on a downward trend, a few spikes there, and ever since, I would say probably, mid-May, maybe the first couple of weeks of May. Since then, we've kind of been, consolidating on volatility. We've had a spike there on the 23rd. And then we've kind of just been going on this downward trajectory. You can see here on the daily chart. And what I'm going to do really, really quick here is I'm going to refresh this and go back to I'm going to show something that pops up there. And so I'm going to go back to the UVIX. We're on the daily. All right. And then what I'm going to do is go here to the, actually to the VIX is what I want. Yeah, we want the VIX. So I go to the VIX, and you can see on the screen here, the Gen X had a line here, a green line. Did you see that line there, Danny?
I didn't catch that.
And so what it's showing is a support zone right in this area, anywhere from, let's say, 14.5 to, let's say, about currently at about 16.5. So we're right at this point of support.
Right.
It's not really, let's say, support as much as the technical indicators are showing it as a support, but volatility is dependent on market. I think, Danny, you mentioned before the call, we were talking a little bit about, this being the inverse of the S&P 500.
Yeah. So we were just talking about the inverse of the S&P 500, and so as the market is good, the UVIX will go down, and as the market is not so good. It's almost a reverse. So when you're doing, if you want to just kind of explain, when you're doing a put or doing a call, it's really the same concept as doing a normal options trade, but you're just have different assumptions in terms of what the market's doing. So that's just something to consider. And I know Mark's going to do a more in-depth video on the VIX and the UVIX. So look out for that. That's going to be really insightful. But this is definitely a good stock to trade, good ETF to get into some options on. So I'm looking forward to get in. I just got out of a couple of options that I was into. So looking to get some more money in and create some additional cash flow here.
Right. So no, definitely. So here's the S&P 500 SPY, and you can see the trend that it has. If you look at the UVIX or the VIX, it has the trend almost identical, but the opposite. So there's a way here I can do invert the scale. So if I invert the the VIX, which is volatility, and you look at SPY, you can see it's very similar in pattern, right?
Yes.
You can see the shape is almost identical,
Right.
not quite, but very close, right?
Yep.
And so when the S&P 500 goes up, the VIX most of the time goes down, and following the opposite trends. And so what we're looking at, rather than, you can invest in VIX, but looking at this as a support zone, looking at historical data, I would say about a 14.5 is probably the bottom.
Okay.
Similar to the bottom here, we see at about a 14.5 of support here. And then we have a trend line that's coming up here, providing maybe some additional support. And inversely, if we look at the SPY, it's basically saying, hey, we're at all-time high of SPY at about 613, 614. And if I were to draw a trend line to where we're at now, we're pretty much looking at this. So when we're looking at this, looks like maybe an iceberg down here. And we look at the VIX, looks like a mountain up here. So looking at, what are the probabilities of SPY breaking out now? It's very possible. We had good CPI data this morning. Consumer price index, right, became in lower than expected, which means inflation is coming down. So there is probability that SPY is going to continue to make higher highs, and most likely will pass the recent high. How far will that high go? We don't know. The high, as in long-term trends, we know that the SPY, progresses in a positive direction over a long period of time. If you go out in the yearly graph, if we go to the weekly graph and extend that out, you can see it historically, SPY is on an upward trend, right? And so we'll have pullbacks, but eventually it goes to new highs. Pullbacks, eventually to new highs. And so, going back to the daily, we can see that we're approaching a new high. There's a little bit of resistance here. And now, in terms of selling options, what we're looking at, is we're not maybe going to hold this for, in terms of a long-term buy and hold. I'm not going to buy and hold volatility and hope that it goes up. That's not the goal. What we're looking at here, Danny, is you can see that even when volatility hits low levels, so let's say here, right, December 26th, it was at, let's say, a 15.5, and then shortly after, you can see it hit levels of 19. From 15 to 19, that's almost a 20% increase in just a few days, maybe a week. We hit these bottoms, let's say here at 15, and within a week, or the 24th, and then by the 27th, you're up at 21. So there are 20% moves that can happen, right, in a very short time frame. So looking at where we're at now, even this little spike here, if I take this little measuring thing here and just even from there to there, that's 37, 38%. That's massive. That's a massive move. Even half of that, even one little candle is 13%. So these are significant moves. So what I'm looking at today, Danny, is saying, look, if we get into this trade here, currently at 16.37, right at that yellow line, if we were to even just a slight volatility back to maybe even the next yellow line here, and I was to measure that, that's about 11%, 12%. So let's say a 10% move. So any type of volatility is going to just bring us and give us momentum in a positive direction. And so when we're selling options, there's two things that can happen. The stock can go down, or the VIX can go down, or the UVIX actually is 2x the VIX. So 10% on the VIX, a small move like this, you can see is 20%. That's a tiny move for 20%. So, and then somebody can say, well, what happens if the VIX goes down and you get assigned? Okay, well then it becomes a hedge. To me, it becomes a hedge of, we get assigned at a value that's lower than 23 because we're probably going to pick a strike price that's down here somewhere.
Yep.
And so we're going to be at a level that we have not been before. So if I do get assigned, or we get assigned at this lower level, then we own the shares at that price without taking a hit. We still collect the premium, we get assigned. And when there's a spike of 10%, 20%, $5, five US dollar move, that's $500. And then we can exit as a hedge, because when volatility goes up, the stock prices and the market typically goes down, which means our portfolio may take a little hit with the market downturn, but the volatility, we're going to hedge and make some money on the stock and the premium we collect while it's doing that. So it's at levels now that I believe is a good time just to make a calculated risk, Danny.
No, absolutely. And that's where, looking at the charts and being in the market on a daily, when we see opportunities, we're going to share them with you guys, and we're going to take some action on those trades. And you can join along and become a member of our Discord and be part of the community, to where we because not everybody has the opportunity to be in the market on a daily basis. Everybody's got kids and family, so come on and join with us, and we'll insights that we're doing. So this is one of the trades that Mark really likes. He's introducing me to this trade, and we're going to open up a paper trade on my side, and so we'll share the progress as it moves forward, and we'll on the next video you'll see how we did.
Yep. So yeah, this trade is twofold, right? Like I just mentioned, number one, it's an opportunity to make some premium on a cash secured put, and if we get assigned, at a level of very low volatility, which historically does not stay there. Even if it's long term, it stays there. There's going to be spikes and jumps that while we're monitoring the cash secured put, we're most likely going to be closing this one out early on those jumps, for up to 50 to 80% of the premium short term. So we'll see how it goes. This is it's more of a risky trade. It's not a conventional stock trade where you're trying to own the shares and hold them long term. We're taking a little bit more risk. We're going to be doing it in Danny's Webull paper trading account. So you guys are going to get to see how that works. You can see in my go here real quick. In my personal account, I currently have a live real money UVIX cash secured put that I have now. So because I don't mind owning some volatility, because when volatility hits, I'm going to hedge my portfolio some and also gain some extra income in the process. So what I'm going to do is I'm going to trade UVIX options, because they have options on 2x ETF, right? Which is, it's leverage on top of leverage. So it's highly leveraged. It's a derivative of a derivative, if you want to call it that. It's an option of a futures option contract. So 2x, a 2x option on a futures contract, right? So I'm going to click sell put, which is a cash secure put. I'm going to go out about 30 days to July 11th. And what we're looking at here is, the support. What was the support levels we were looking at, right? So we're here at about 23.74. If I'm looking at the VIX, we're looking maybe about a 14.5. So that's about a 2 point. So maybe 4 points on 2x, right? 2x is 2 times. So maybe a 4 point delta. So if we're currently at 24, if I go down to a 20, let's say, in terms of support, that's about a 0.21 delta, right? 21 delta. And for Tech Hedge Pivot, Danny, and our strategy, we're always going to start analyzing at the 20 delta to 30 delta, 0.2 delta to 0.3 delta. So the 20 delta puts us right there at the 21, 22, which is pretty conservative.
Yep.
And then we have the 21 here is at about a 0.27. So ironically, that $4 spread of support puts us right at about the point of probability of, let's say, a chance of profit is 70% to 75% chance of profit, according to Robinhood. And basically the delta, says there's about a 21, 22% chance of UVIX going to this level. 21 delta says there's about a 28, 29, 28% chance of it going to this level. So the further away you are from the money or from the current price, the less chance it has of getting there, right? So like you go down to 18, what's the chances of it? 10% chance of it going to 18. So because there's less probability of going there, you can see the premiums a lot less.
That's right.
So I think in this case, Danny, if we want to be a little more aggressive, we probably go towards the
27,
27, 28 delta. We could even get a little more aggressive and even go to the 34, but we're already going.
Yeah, if we stay between the 20 and the 30 range,
yep.
I'm good with that. 70% chance of profit, and we're under the 30.
Yeah. So what we're going to do here is I'm gonna write down delta at a 0 point. Now it says 0.26, and the implied volatility. So here's delta 0.26126, and implied volatility here at 87.
And the reason Mark's doing that is we put that into our calculator. So when we're done doing the trade, we take the implied volatility percentage and a lot of these numbers, and we transfer those over to the tracker sheet.
That's right. So what I'm going to do is click here, and what we're going to see is that there's a spread, a bid and an ask. And typically when we do bid and ask, we want the spread to be tight. We don't want a lot of delta there. Delta meaning the variance between the bid and the ask price. But if I were to take a midpoint here of, we could do that on our little calculator. So 0.64 plus 1.51 and divide that by 2. So we're probably like at a 105, 1.05.
That's right.
Right. So that's $104. And you can see the collateral is going to be 100. There's one contract has 100 shares, so that's $2,100. So here, if we take 104 divided by $2,100, that's about a 5% return on investment for the month, and not bad, $100, right?
No, it's great.
And your break even, you can see here, if you take 21 and subtract the dollar from that, a dollar, you can see it's about $20, right, as your break even price. So UVIX would have to fall to $20 as a break even. you'd be assigned, you'd own the shares at 20, but you would not have seen a decrease in your account value because the offset of the premium lowered your entry point to $20.
Correct.
Right. So if we looked at, I'm going to look at this really quick at $22. So we can see the bid and the ask is a little tighter on the $22. I'm just going to take a note of the delta of 0.33 and the implied volatility of 101. And you can see the bid ask. If I take the midpoint of that, I guess we can do that here. So about a 1.8, which is about $180. That's going to be one thing to consider. If we do a market entry in the Webull, it may, the bid-ask spread, it may be better to have a tight bid-ask so that your market entry is closer to the premium that we're targeting. So maybe we'll do the 22, Danny. We'll do it, right?
Yeah, and the reason is because on paper trading, we typically don't do limit because sometimes the orders don't get filled. So we just typically go with a market order for the sake of just practice. But once you get into real money, you always want to be on the limit order. We can show that
That's
on the
right. Here's what I would
yeah, no,
think is
that
going
makes
to happen.
sense.
This is what I think is going to happen. Like I said, short term.
Yep.
Not on a whether that move happens to tomorrow, next week. There's a point where the VIX is just going to have as the market consolidates and does a retest or a little small correction.
Yes.
The UVIX will do the opposite.
That's right.
mean, the VIX will do the opposite, and then UVIX will do 2x that.
Correct.
And so even a small move like that will be 20%, which will give us allow us to close the option contract early to cash in on some of that premium. So
yeah.
All right, Danny. So we're going to do the 22
Okay.
Strike price.
All right.
At an expiration of July 11th, which is about 30 days.
Okay.
And I'll go ahead and turn that over to you.
All right. That sounds good. So here we are on Webull. I'm going to come over here to this tab. This is where you set the time frame, which I already have it set up for here on the date. So we're all set there. I added it also to my watch list. So UVIX is there. When you add it to your watch list and you click on it, it goes and it transfers to all of your different widgets. So now we are here, and this is our option chain, and we're going to look at the 22, right, Mark? That's what you're talking about?
Yes, that's correct. So we're going to
click on the 22, and we are going to, you can see on this section, we have a put section.
Yep.
And we're going to come over to our order section where we have it set at limit. That's our default. We're going to be in the market, and we're also going to do, how many contracts are we doing?
Yeah, well, we're looking at, you got $150,000 account. So we were talking about, do we want to do 5% or 10% of of your portfolio in this trade? Being that the VIX can be a hedge, let's say you get assigned and the market just collapses or fear or downturn or correction, then the VIX is going to take a pop up, right? So
that's right.
I think this could be a hedge, depending on the risk that people are willing to take, it's a possible hedge, right? It's one that you would want to take the time, if you're watching this video, take the time, learn about the VIX, learn about the UVIX. There's other hedge type ETFs like TMF. That's also a 2 or 3x leverage on treasury bonds, 20-year treasury bonds. So there's bonds and treasury, bonds and things that you can, treasury bills that you can invest in that maybe be a hedge to the market as well. So definitely want to, encourage people to look into those types of things because they do the opposite of what the general stock market does at times and can be a hedge for your portfolio. So got a little sidetracked there, but it's important to note. That's kind of what I'm doing. That's what we're doing here
That's
is
right.
we're going to be looking at the VIX and the UVIX as a potential hedge to our portfolios. So yeah, Danny, I think you got it on the sell side because we're
Yep.
selling the put.
Yep.
So if we do 10%, then our collateral would need to be about $15,000, right?
Okay.
So if that option contract you can see is $22 strike price, then times 100 is going to be $2,200 per contract.
Yep.
So if I take 10% of 150,000 at 15,000 and divide that by 2,200,
Yep.
then I would say 6 contracts. You can go as high as 7.
Yeah, we'll be a
And
little
that'll
bit
give
aggressive
you,
on this one, I think, because we just closed out some options and we made nice profit. Not that that has an impact, but based on the cash that we have available at 150,000, we're still going to have a lot of room to get into other trades as we see those unfold over the next couple of days. So I'm really comfortable with this.
okay. Well, why don't we just go ahead and hit the
All right. So before I do it, I just do a quick check. I'm on 22 is my strike price. I'm going to sell. I'm on market, 7 contracts. You can see amount estimated is 1,143, and I will click the button. All right. So it's in, and you can see here on the bottom we have a working, and it looks like we got filled. These data points, we'll go ahead and enter those. We'll do a video showing how we go from this trade into our Excel sheet where we actually track it. So that'll be probably something we'll do next, and that's going to be a good video to look out for.
yeah, yeah. And one of the cool things you can see when you see the average price, that's the average price that you paid, 1.84. And if you look at the option chain above, I guess the paper trading on the market did a good job of finding that midpoint.
Did a great job.
Right. So it's
Right in
if
the
we were to do a limit order, we'd probably pick somewhere in that range ourselves. So that's good to know that the market order on the paper trading account is providing us a midpoint entry,
No, that's good.
which is good. That's good. So yeah, based on that, Danny, your trade is entered. Now we'll do a little bit of math here.
Okay.
What I'm looking at is $2,200. Is if you go to the left on the actions, you got symbol in the position, right? In the position thing there, you got symbol. You got $22 strike price, right? Which is $2,200 times. Then to the right, you got 7 contracts, which is about $15,400.
Yep.
And the total cost is really the total premium. So I'm going to take $1,288. And I'm going to divide that by $15,400, and that's about an 8% ROI for 30 days. So 8% return on that investment of $15,400, and times 12, that is actually 100% ROI for the year in terms of premium collected.
That's right.
Right. So, all right. So now what we're going to do, Danny, if you want, we could open up that tracker if you can open that up.
You got it.
So yeah, Danny. So now that we got this all set up, everything's good. We'll go ahead and go over to the tracking sheet.
Okay.
That you've been working on.
So you can see here we're actually up $7, so we can close out the contract right now and be profitable. But you know what? We're gonna let it roll. We're gonna let it roll a little bit. All right. So I'm gonna start here on the left mark, and right now we have our status is open.
Yep.
Today's date.
No, we don't need that. There's no dividends or earnings date for volatility index.
Right. Open date.
And the open date is today.
6-11-25. Okay. And what's
611, and then UVIX.
UVIX. Okay.
Go to the right, and we're going to do cash secure put.
Yep. All right.
And your delta is a 0.34.
Okay. All right.
You could just put 0.34 because we know what it is.
Okay, got it. Okay.
Yep. And then volatility is 105. So a little higher volatility. Like I said, this option contract's a little more risky. We like generally between the 20-70% is comfortable, but like I said, the market right now is at a place where the volatility is at an all-time low. Not all-time low, but it's at a point where any spike will allow us to close this contract out for profit. So the ticker value, what did we have there? 23.5, I believe, is where it was.
Okay.
And strike price was that the 22? Is that what we went for, Danny?
Yep.
Probably go back in. Yeah, 22, right? Because it was $2,200, correct?
22.
And the expiration date is going to be July 11th.
Okay.
And I believe it did 7 contracts. So you can see total days to expiration is 30. We got 7 contracts at a 1.84. And so you can see the total premium on 7 contracts is $1,288. And then this section here will fill out when we close the contract early, and we'll determine, if we have to close the contract early, we will buy. We sold the contract to open the contract, and if we want to close it early, we can buy the contract early. We can buy it back at a lower premium and lock in a percentage of the profit.
That's right.
The contract will stay open
for
the 30 days unless it's assigned, which means the buyer, the strike price goes, or the price goes below the strike price. The buyer decides to exercise their option, and then you'd be assigned the shares.
That's right.
700 shares, 7 contracts.
Yep.
But you would collect the $1,288 premium. So we can let it expire worthless, get assigned, or we can buy back the contract early and lock in a portion of those of that premium.
That's right. And one way to look at it too is if we were to say, okay, Mark, how much would this cost to buy the contract back? Well, we have $7 in profit. So technically, if we paid $1,280, we can buy the contract back and capture that $7.
Right. So there on the left, you can see, Danny, where it says market cap.
Yep.
So you can see, if you open that up a little bit, open up that so you can see it.
If I can get this little line here.
Right. So if you can buy back the contract right now for $1,281, and the difference between the total cost and what you buy it back would be $7. So you would collect $7 in premium.
That's
if
right.
you did that, right? So over time, if the VIX decides to go up, our cash secure put, the contract value goes down, which means our premium that we can buy back the contract at a lower value, lock in a portion of that premium there. So, so yeah, you can see there the actual ROI. Your cost basis is 15,400, and your ROI, if you allow it to expire, would be 8.3% on $15,000, which is a great investment. If we mitigated the risk at this low level and feel good about that support, I think even if you got assigned, it's a great great point to be at. Your average dollar per day, if over 30 days, you divide the $1,288 of premium by 30 days, you get $43 a day. And then to the right there, you'll see at 80%, if you can collect $1,000 on this trade, Danny, within the next week, that'd be pretty awesome.
Yep, exactly.
And then the break even on the right-hand side is basically, the $22 strike price minus the premium, $1.80, gets you at about $20.16 would be your break-even point. So anything below $20 would be a decrease in your account. And you'd own the shares at that point. So once the volatility goes above 20.16, you'd be profitable at that point. So, and then to the right of that, you can see it's about overall, it's about a 14% decrease of the current price of the UVIX. So, no, this is going to be exciting. I'm looking forward to seeing what the outcome is of this trade.
Definitely.
So yeah, Danny, that's it. We got to do that, and yeah, it's pretty interesting. get an opportunity to see how the UVIX performs. So
Absolutely.
on
No, that
the
was a great insight. Looking forward to seeing how this runs out, Mark. I know everybody got a lot of value there. So if you're interested in coming on board and being a part of the community, there's going to be a link below where you can come on in and join. We're going to be sharing all of our insights. We're in the market on a daily, so come on in, join our community, hit that like button, subscribe. Mark, thanks for the insight. I'll be looking to get into some real money here probably within the next 30 days. So I'm going to be transitioning from this paper money into real money, and things really aren't going to change. So you'll see when we do our trades, it's going to be very similar. Mark's also going to be showing some trades that he's in as well. So look out for those videos.
No, thanks, Danny. No, I appreciate that. Don't forget to hit the like, subscribe, hit the notification bell, and we will see you next time. Thanks,
All right,
Danny.
guys.
Talk to
Take
you
care.
soon.
Bye-bye.